Adobe is down 14% after reporting its earnings yesterday after the bell. It now looks like a very strong opportunity to consider for your portfolio. As always, we're going to look at the historical performance of this company. We're going to look at their top line revenue to understand the growth of this company. We'll look at their bottom line net income as well. We also want to have a quick look at the health, total cash versus total debt, as well as comparing them to their competitors within the industry over the last few years. We'll also touch upon some insider selling that we have noted over the last few months, and we'll look towards the institutions to understand whether they are still buying this company in the more recent quarter. And as always, we want to find out in terms of the metrics, the free cash flow, their net debt, whether this is a strong company for future growth. And importantly, we're going to understand why the shares have fallen after beating both top line and on the earnings per share. And finally, we are going to run it through the valuation model, getting to our own intrinsic value, looking at our acceptable buy price, considering our investor margin of safety, and seeing whether or not Wall Street do still see upside for this company over the next 12 months. Before we take a look at their earnings, let's just look historically at their performance. They are up 71% over the last year. They are now trading after the drop today in the midpoint of the 52-week range, with a forward PE sitting below 32, and we can see the market cap at 258 billion. Now, if this is a company you have been holding over the last 10 years, you would be up around 750%, and we can see their all-time high is sitting just under $700 over a few years ago. Now, in terms of the earnings, let's take a look, see what's happening with this company, why the double-digit drop to their share price. And we can see that the headline does reveal that they did issue some strong quarterly results. However, the issue that was for Adobe, hence the price drop, was their revenue guidance, which seems to be the way that a lot of these companies are going, especially the tech companies, giving some very strong reports for their latest quarter. However, they are looking at giving that soft guidance, and we can see in Adobe's case has really punished them. They also talk here about how they've paid $1 billion to essentially abandon their acquisition plans, but they are announcing that they are working on an early version of artificial intelligence assistant for their Reader and Acrobat apps. Now, looking at the numbers themselves, we can see here that they did beat on the earnings per share, 448 adjusted versus the 438 that the market had expected. And they also beat on that top line, 5.18 billion, coming in higher than the 5.14 that the analysts had expected. We can see when looking at the comparison versus the last quarter over the last year, they did grow their top line 11%. But the one thing to note, their bottom line did decrease to 620 million, as the same quarter from last year was nearly double that, or in fact around that at 1.25 billion. And as we mentioned, they did essentially look to cut their acquisition of Figma. Now it cost them around 1 billion in the 20 billion acquisition that they were looking to do and go ahead. So they did have to pay that termination fee. Now, in terms of the top numbers, what we like to see, 3 to 7%. For companies that are more technological, going at a faster rate, we will expect a little bit higher. 11.2 billion reported in 2019, 19.4 in 2023, their latest results. So we can see over the long term, over the last 5 years, they have increased their top line very, very strongly. And when we look on a more granular level, we also see increases year on year, which is a very positive sign. And for those that like to see the percentages of that, we will cover that shortly over the last 10 years. Bottom line, well, 3 billion reported in 2019, 5.4 in their most recent quarter. Though we do note some inconsistencies, it did increase into 2020 before dropping down all the way to 2022 before rebounding back up. So over the longer term, top line and bottom line have increased, but we do see a little bit of inconsistencies on the net income front with Adobe. In terms of a quick health check then, total cash versus total debt, 4.2 billion reported in November 2019, 6.8 billion in their latest quarterly report. So they do hold around 50% more cash today than they did 5 years ago. When we compare that numerically and directionally to their total debt, you can see it's gone from around 4.2 billion to around 4.1. So it has moved or decreased very, very small, with the cash position looking fairly strong. So there shouldn't be any issues when we look at the net debt to EBITDA metrics later, but again, we will cover that. In terms of looking at their competitors, well, we have Salesforce, SAP, Intuit, and a few others in the application software industry. And what we can see over the last 12 months, Adobe looking very strong. Now, they are one of the worst performing, but bear in mind, this industry has performed very well over the last 12 months. They are up 48%, so that is pretty strong, although we can see here other competitors like SAP, like CRM Salesforce performing slightly better. Over the last 5 years, well, we can see again Adobe, one of the lower performings, but not a bad 91% return. Again, we can see others like Intuit doing very, very strongly, as well as SMPS and CDNS. So overall, they haven't performed too badly over the last 5 years, over the last 12 months very strongly, but remember that past performance is never an indicator of future. Now, we've looked at insider buys and sells. What we know over the last few months, in fact, in the end of January 2024, the senior vice president as well as the chief strategy officer have both sold shares. Essentially, the CSO did sell around 1.9 million worth of shares, with the SVP selling just under 500,000. Now, we can see since they've sold, the price has dropped quite dramatically, but I would say this isn't necessarily a bearish signal. Nonetheless, we are showing it to be transparent. They do sell for many different reasons. Now, institutional ownership does sit at 80%, as we can see here. 18.2 billion worth of outflows sales by the institutions over the last 12 months, but a lot more buying over the same period. So we can see institutions that do really like this company. They have been buying a lot more shares, considerably in quarter 2, but we know in fact in quarter 3 there was a little bit more selling than buying. In the more recent quarter though, double the amount of buying than selling. So not just over the last 12 months, but also in the more recent quarter, we do see the institutions becoming very bullish on this company. Now, in terms of the financial metrics, let's take a look at the free cash flow growth, and we can see it has grown quite nicely from $2.29 in 2014 to $15.20. We do know the dip from 2022 to 2023, but also nice to note 2024 they are expecting a large growth to that free cash flow, and overall on the long term they are increasing that free cash flow in the right direction and at a very strong speed, so that is a positive sign for Adobe. Sales growth, remember we're going to look at this percentage-wise, pretty much double-digit increase to their top line every single year. 2023, the more recent year at 10%, looking very strong. Now, you can argue a bit of a slowdown, and there was mention of that soft guidance to their top line in their earnings. Something to consider. Nonetheless, historically, they have had a very strong growth to their revenue. Numerically speaking, then, it's gone from just over 4 billion to just under 20 billion in 2023. So again, very nice, nearly 5 times growth to their revenue over the period. On top of that, they are doing some share buybacks, as we can see, 508 million in 2014, 458 in their latest period. So they are returning that excess cash to investor pockets through essentially increasing your ownership in the company. And in positive news, they are also doing a lot more share buybacks moving forwards, as they did announce in their latest earnings. ROIC, this is what I love to see, increasing return on invested capital. 2015, it was pretty strong at 10%. That is the minimum I want to see, just to give me faith that management are able to effectively allocate their capital. It has been increasing over that period as well. Last 3 years in the 30s, very, very strong. Definitely do understand these metrics. These are very positive for this company. Operating side, well, operating efficiency looking very strong, increasing from 10% to around 34% in the more recent year. We ideally want to see a minimum of 16%. So the fact that from 2015 it's been above that and increasing is a very strong sign. And the free cash flow margin as a whole is fairly consistent. Very strong numbers here, 36% in 2023. Very, very nice to note. Very attractive as an investor. Net debt to EBITDA, then earnings before interest, tax, depreciation, amortization. We can see over the last few years and in 2024, it won't even take them 1 day to pay off all of their debt net of cash on hand, showing us that they do have a very strong balance sheet, as we noted in our very high level review. Now, just to let you know, before we look at our valuation, we have released our latest free weekly article. If you want to gain access to this, as well as other articles we have, all completely free, do click on that pinned comment below. So let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we're going to look at the first model today, is the multiples valuation model. We've got those companies in a similar sector and size that we analyze to compare. We have their average PE, as we can see, just under 62, with the EPS of Adobe giving an intrinsic value of $728. So we have our first sign of undervaluation, although bear in mind we're not looking at any of these models in isolation. Now, they don't currently pay a dividend, so this model is redundant for now. On the discounted cash flow, we have their free cash flow year on year. Now, average has been 23.5% over the last 10 years. Forward looking, we've gone a bit more conservative, around 12%, which is also significantly lower than management estimates. In conjunction with our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here another signal of undervaluation. Now, the intrinsic value for today's episode is purely the average of these two models, and it gets to around $652. Now, remember, you can grab a copy of this valuation model if you want to get to the intrinsic value or the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment. So, margin of safety, as always, we start off with 10%. It is important to understand that we use the 10% if it meets three criteria: the wide moat, strong financial metrics, and good forward-looking data. So we can see at a 10% MOS level, it's a buy up to $587. At 15%, up to $554. At 20%, $521. So we can see there is a fair amount of margin of safety baked into this price now. At around 25%, it is essentially $1 away from this current price, and it could essentially get there today. So we see around a 25% margin of safety for Adobe in the current market after the massive sell-off that we did see today by the market. Now, you could argue that is a market overreaction, and with Wall Street, their new forecast is looking at around $640. So they do see this as a very, very significant buy. 31% is their estimation upside percentage-wise, with that target of $640 over the next 12 months. Now, as we always say on the channel, do take Wall Street's forecast with a pinch of salt. If the price goes up, they revise it upwards typically, and the opposite is true if it goes downwards. So whilst you can use that as one element of your investment thesis, don't use that as the sole reason to invest in stocks. Always do your own due diligence. Now, for those interested at a 30% margin of safety, that would be around $456. So we can see it really does come down to your MOS level. As always, though, do let me know your thoughts in the comments below, whether or not this is one you are now looking to pick up or you're waiting for a smaller drop. Now, personally, this is one that I have had my eye on over the last few months. It is one that I will be looking to add to the portfolio. In terms of the metrics, look very strong. The growth prospects as well, I do believe there is some market overreaction to these numbers, although I will be waiting for around a 25 to 30% margin, so I may possibly dollar cost average into this stock after today's episode. As always, though, do let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.